Hello, everybody. My name is Yaman, and I provide daily updates on Tesla, markets, and technology. Let's get started. Markets are up a little bit today. Dow Jones up 0.2%, Nasdaq up 0.4%, S&P 500 up 0.2%. Russell 2000 small cap stocks are down 0.5%. Oil is down 1% to $62 per barrel, and the yield curve is up a few more basis points. 10-year Treasury yield is up to now 4.14. Let's read the daily article. Wall Street steadies with indices on track for weekly gains. FedEx jumps. Wall Street's main indices were muted in choppy trading on Friday, with Nasdaq easing from a record high, while FedEx rose as the parcel delivery firm posted upbeat quarterly results. FedEx gained 2.7% after reporting quarterly profit and revenue above analyst estimates on Thursday, as cost cutting and strength in domestic deliveries helped offset weaker international volumes. Apple added 2% following a price target raise from JP Morgan, while Tesla was up 2% after a report of Baird's upgrade on the stock to outperform from neutral. Their gains boosted the S&P 500 tech and consumer discretionary sectors. Let's move on to Trump. Trump's call with Xi Jinping gets underway with TikTok deal in high focus. The highly anticipated call between President Trump and his Chinese counterpart, Xi Jinping, is underway, with the fate of TikTok and potentially the trade relationship between the world's two largest economies in balance. Trump this week set lofty expectations for the call, which began at 8 a.m. Eastern, according to a White House official. The president is expected to share updates on the conversation later on social media. Before the call, the president described a deal over TikTok as all but completed in multiple comments Thursday, adding that he is looking to make progress on broader issues like tariffs. The president spoke about negotiations around the social media app during an appearance in the UK in the past tense, even as some issues remain publicly unresolved, as he promised that the final company will be controlled by all American investors. My relationship with China is very good, he added later in the day in a Fox News interview, and it sounds like they have approved TikTok. The president then added that he is also looking to discuss an array of issues with his Chinese counterpart, from Russian oil purchases to tariffs, saying we're very close to deals on all of it. Chinese state media confirmed Friday that the call had begun. It had previously reported that a TikTok framework deal had been reached, but consistently offered a somewhat different summary of the deal. It recently said, among other things, that there was a consensus reached by both parties for the continued operation of Chinese enterprises, including TikTok, in the United States. The core question surrounds how the Chinese control algorithm that has long powered TikTok will continue to be used if the app is spun off into a separate US-led company. Trump offered little insight on Thursday, saying TikTok has tremendous value. Rather than let it go to waste, he added, I'd rather reap the benefits. Reports of the deal have suggested that the consortium led by the tech giant Oracle, venture capital firm Andreessen Horowitz, and private equity firm Silver Lake Management will spearhead the attempt to keep TikTok operational in the U.S. Trump sounded very confident on Thursday, adding that he expected to address a range of other issues on Friday and that a partial tariff detente could be extended. We may do an extension with China, but it's an extension based on the same terms that we have right now, which are pretty good terms, he said. Continuing on to the Congress, the GOP has a plan to avoid a September 30th shutdown. Democrats aren't yet sold. House Republicans advanced a bill Friday morning to keep the government open for 7 additional weeks in an attempt to pressure Democrats to relent and accept their plan to avoid a partial government shutdown that could start at the end of this month. The 217 to 212 vote in the House of Representatives was on a measure to keep the government open until November 21 and provide additional millions for lawmakers' scrutiny in the wake of assassination of Charlie Kirk. The vote came in almost exactly on party lines, with Thomas Massie of Kentucky, Victoria Spartz of Indiana, and Jared Golden of Maine crossing party lines. Massie and Spartz are 2 Republicans who bucked their party to vote no. Golden is a Democrat who voted yes. The Senate is aiming to take up the measure later today. That's where things could get bumpier. With the 60-vote threshold, there meaning Democratic votes are needed for passage. For now, Democrats are united behind a different plan, with Democratic leader Hakeem Jeffries saying Friday morning, quote, We are a hard no on the partisan Republican spending bill, end quote. He described the vote as a choice between standing up for the healthcare spending Democrats want to include or, quote, bending a knee to Donald Trump, end quote. This latest bout of back and forth as markets decide whether to worry about the economic effects of a possible shutdown comes as Congress faces a September 30th deadline to either extend funding or move to a partial government shutdown. Democrats are pushing their own plan, which includes a longer list of priorities focused on reversing recent healthcare spending cuts that Jeffries and other leaders say need to be included to secure Democratic votes. The Senate is expected to consider both the Republican and Democratic plans as early as this afternoon. Both bills are expected to fail to reach the 60 vote threshold. That means the widely expected bottom line is that today's back and forth will only be a prelude to a final frenzy of talks on September 29th and 30th, when lawmakers return after a planned recess next week. The probability of a government shutdown has increased significantly, Raymond James noted in a Thursday note to clients. Markets are paying little attention so far, a pattern that has recent historical precedence. One possible reason is that government shutdown since 1995 has had little effect on stocks, according to Raymond James' review that even found that the S&P 500 went up on average during those funding gaps. Switching to Fed talk. Bouyard says he wouldn't have backed a 50 basis points this week. Former Federal Reserve Bank of St. Louis President James Bouyard, who is in the running to be the next chair of the U.S. Central Bank, said that he wouldn't have backed a 50 basis point interest rate cut this week. Quote, I thought the Fed decision was a good one, Bouyard said Friday on Bloomberg Television. Asked if he would have voted for 50, he said, no, I don't think so. He also said that this looks like a sequence of 3 moves in a row through the end of the year. Here's a picture of Bouyard. The Fed lowered borrowing costs by 25 basis points this week, a move Chair Jerome Powell framed as a risk management cut to bolster an increasingly fragile labor market. The decision was nearly unanimous, with the only dissent coming from Steven Miran, a Trump ally who officially joined the Fed board this week and favored a 50 basis point move. A total of 75 basis points of easing by year end would have been a significant move, but still leave the Fed with optionality going into the next year, Bouyard said. He estimated the so-called neutral rate, which neither stimulates the economy nor restrains it, at around 3.25%. For the Doves, getting 25 basis points this week and another 25 in October is almost as good as getting a half percentage point this week, he said. Bouyard earlier this month said that he spoke with the Treasury Secretary Scott Bessent about becoming Fed chair. Bessent said this week that there was a very good meeting. Bouyard Friday said that he knew virtually all the candidates in the running and that they were good. The former Fed official, who is now the dean of Purdue University's business school, also said that it might have been a mistake for the central bank to have loaded up on mortgage-backed securities purchases during the spring of 2020. In the end, the housing market strengthened after the initial COVID shock, and such support wasn't needed. Now it will take a long time for those securities to run off the balance sheet, he added. Let's move on to Intel. Intel's biggest problem isn't going away with NVIDIA's $5 billion stake. This is a Laura Bratton opinion piece. Investors may have cheered NVIDIA's announcement that it will take a $5 billion stake in Intel, with shares of the latter soaring as much as 30% Thursday. But the investment does little to solve what's arguably Intel's biggest problem: how to fix its ailing contract chip manufacturing business. As part of the deal, which gives NVIDIA a 4% stake in Intel, NVIDIA will use Intel's CPUs in its AI data center server systems, and Intel will use NVIDIA's AI tech in its semiconductors for personal computers. But crucially, the agreement made no mention of Intel's manufacturing business, Intel Foundry Services, the segment of Intel that has drawn widespread attention from investors and the US government and is struggling with heavy losses as AI has upended the chip market. Intel has always manufactured its own semiconductors, but the company opened that manufacturing business to outside customers in 2021. The chip maker, helmed at the time by former CEO Pat Gelsinger, launched Intel Foundry Services in a bid to revive the company as its product business lost share to competitors. The plan entailed spending hundreds of billions of dollars on new factories that would make chips for other companies. But Gelsinger's high hopes for the business largely floundered due to a lack of big customer commitments. Let's move on to market news. Stock buybacks have slowed. Here's why it matters that they could bounce back. A slump in stock buybacks could be in the rearview mirror. What the means in stocks is more complicated. S&P 500 buybacks in the second quarter fell 20% from record highs in the first quarter, but they are expected to tick up in the current one. With economic policy uncertainty starting to dissipate and interest rates headed lower, repurchase activity from the companies in the broad market index is expected to return to record levels according to S&P Dow Jones indices. Wall Street analysts, however, say buybacks may not be as helpful to EPS growth as they once were. Headline buyback figures are big, but their growth has stalled lately, even for the biggest companies in the index. Companies like Apple, Meta, Alphabet, and Nvidia, which usually account for about 30% of annual buyback spending, posted no meaningful year-over-year growth in the second quarter, according to a recent Goldman Sachs report. Let's switch to company-specific news. OpenAI taps Apple's supplier to make AI device, the information reports. This is an important piece of news. OpenAI has signaled a deal with Apple device assembler Luxshare to make a consumer device, the information reported on Friday, citing people familiar with the matter. The device is currently a prototype under development and is expected to be pocket-sized and aware of context, designed to work closely with the ChatGPT parents' AI models. Such a gadget could eat into the markets of Apple and other consumer electronics makers by offering an alternative to users for interacting with AI, challenging the dominance of smartphones and traditional hardware. Luxshare and OpenAI did not immediately respond to Reuters' requests for comments. OpenAI bought startup IO Products, founded by former Apple designer Johnny Ive, earlier this year in a $6.5 billion deal, underscoring its push to move beyond software into consumer hardware. Luxshare, a major assembler of Apple's iPhones and AirPods, would bring large-scale manufacturing capabilities to OpenAI's effort. OpenAI has also approached China-based Gortec, a supplier that assembles AirPods, HomePods, and Apple Watches to provide components, including speaker modules, for its planned devices, the information report said. The project marks one of the boldest bets yet by an AI company to build a dedicated device rather than relying solely on smartphones and PCs. The goal is to create an AI native product, hardware designed from the ground up to work with AI models rather than bolted onto existing platforms. This, according to analysts, could open new markets and give OpenAI a foothold in consumer electronics, an arena still dominated by Apple, Samsung, and Alphabet's Google. Let's switch to a related company, Apple. Apple's iPhone 17 launch draws hundreds in long queue at its Beijing store. Hundreds of people lined up at Apple's flagship store in Beijing on the launch day of the iPhone 17 on Friday, in a sign that sales of the series are off to a promising start in the world's second largest economy. Among the roughly 300 people that arrived in the morning at Apple's store downtown San Lutun to pick up phones ordered online, whose person said he purchased the Pro Max model priced from $1,400 in China and pegged by analysts to be the best-selling model in the 17 series. Let's switch to NVIDIA. NVIDIA explores $500 million in investment in the UK's self-driving startup, Wave. US chip designer NVIDIA has signed a letter of intent for a possible $500 million investment in the next funding round at Britain's Wave, the autonomous driving technology group said on Thursday. The development comes after Britain and the US signed a technology pact aimed at boosting ties in AI and other fields. Founded in 2017, Wave raised over $1 billion last year, led by SoftBank Group and supported by NVIDIA. Ride-hailing platform Uber had also made a separate investment in the firm in 2024 for an undisclosed sum. Wave's technology, unlike conventional systems that rely on detailed digital maps and coding, uses machine learning with camera sensors mounted on the vehicles to learn from traffic patterns and driver behavior. Its autonomous driving platforms have been powered by a partnership with NVIDIA, whose chips are now bolstering a global AI move. The London-based Wave currently operates in Britain and the US and has been expanding testing and development to wider markets like Germany and Japan. On Thursday, NVIDIA had also pledged £2 billion or $2.7 billion in investments in the British AI startup ecosystem. And that leads us into Tesla. Tesla loses another Optimus robot leader and upsets Tesla stock gamblers, according to Fred Lambert. Tesla has lost another leader of its Optimus humanoid robot program, which is upsetting those who bet on Tesla stock, as CEO Elon Musk says most of Tesla's value is tied to the robot. And this is the person who just left. Ashish says he decided to leave Tesla. It's been an incredible ride leading with the Optimus AI team. We went all in on scalable methods. AI is the most significant bit to unlock humanoids, he says. And then Adam Clean, arguably a Tesla bull, says, "What the heck? Why? You're working on the single most important product for the world and you are giving up so soon. What could be more important?" And Ashish says, "Financial upside at Tesla was significantly larger. Tesla is known to compensate pretty well, way before Zuck made it cool." And he says, "If I wanted to optimize for money, I would have stayed at Tesla." So basically, he's saying he's taking a financial cut to go to Meta, leave Tesla and Elon Musk to go to Mark Zuckerberg and Meta, which is really interesting, right? So that says, I think, something about the Optimus program. I've been saying for a while that I think the Optimus program is now on the back burner, and now we're seeing some defects from Tesla to other companies. On that note, thank you very much, everybody, and I will chat with you all next time. Take care.